This is the second in a series of videos covering tax reform, and in particular, the international aspects of tax reform. The video will offer a bird's eye view of the key provisions of the recent tax legislation. My name is Pete DeMarco, and I'm the Senior Tax Executive at Meaden Moore. Prior to my current position, I served as the firm's partner in charge of our tax services group for over 30 years. Again, welcome. Today's presentation, as well as those in the future, will be led by Littman. Alan is a senior tax advisor at Meaden Moore and has gathered over 27 years of experience in tax planning, compliance, and legislation, much in the international tax arena. You can view his background and experience below. Alan, the Tax Cuts and Jobs Act, signed by the President in December of 2017, contained a number of provisions, specifically as it deals with U.S. domestic businesses and the taxation of the same, with a focus on revamping the international tax provisions. Can you explain what some of those provisions are?
Sure. Thank you, Pete, for having me here today. The Tax Cuts and Jobs Act was signed by the President and became law on December 22nd of 2017 as Public Law 115-97. In summary, under the legislation, taxes are estimated to decrease by approximately $1.5 trillion over the next 10 years. The Senate opted to pass the bill by majority vote under its reconciliation procedures. These budget rules require that there be no net deficit incurred outside of the 10-year budget window. To meet this restriction, the Act will sunset most of the individual tax cuts on December 31st, 2025, but not the business or international provisions. Before discussing the international provisions of tax reform, it is important to look briefly at the key individual and domestic business provisions, as these set forth a new baseline for competitiveness within the United States. Competitiveness is an important part of the tax policy that is driving the tax bill. 10-year tax estimates are included so you can understand the overall effect of the separate tax decreases or increases. Here are the key individual provisions. Individual tax rates are lower for 2018 and beyond. The top tax rate bracket will drop from 39.6% to 37%, and overall this will cut taxes by about $1.2 trillion. And qualified business income, or QBI, is income of a U.S.-based business that is earned by a sole proprietor or a pass-through entity. In general, QBI is entitled to a 20% deduction. Overall, this will cut taxes by approximately $415 billion over the next 10 years. Here are the key domestic business provisions. The corporate tax rate is lowered to a flat 21%. Overall, this will cut taxes by approximately $1.3 trillion. 100% bonus depreciation is allowed for qualified property, up from 50%. These special rules will phase out 20% per year beginning 2023. Overall, this will cut taxes by around $86 billion over 10 years. A deduction for business interests will be limited to 30% of adjusted taxable income of a taxpayer. That's all taxpayers, corporate and partnerships or individual. Adjusted taxable income approximates EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Overall, this will increase taxes by $253 billion. The net operating loss deduction is limited to 80% of taxable income with an indefinite carry forward and no carryback allowed. Overall, this will increase taxes by approximately $201 billion. R&D expenses will be amortizable over 5 years instead of currently deductible, and the R&D credit will be retained. Overall, this will increase taxes by $120 billion. We will discuss the international provisions in detail in future videos. I hope that you enjoyed this video. Please feel free to like or comment, and thank you very much. And thank you, Pete.
Thanks, Al.